presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone, and welcome to the Compak YouTube Weekly Update for February 19th, 2021. I'm Moe Ansari, President of Compak Asset Management and host of Market Wrap. Don't forget to tune in to weekly edition of Market Wrap. You can get the app simply by going to the App Store and typing in Ripe Market Wrap with Moe Ansari, and you will get the free update. Every day it'll be downloaded directly to your iPhone. Let's talk about the markets, but before I get to the markets today, let's talk about the webinar next Wednesday night. I'm going to spend 2 hours, and a good part of that will be dedicated to answering your questions. Anything you want to know, financial, anything, your favorite topics, I will be more than happy to answer as many of those questions as I can. That will be on Wednesday night, 6 p.m. Pacific time. Just click on the link below to register. If you've already registered, you are going to get the access code. It's all free and it's all information. Hopefully, I'll give you some more feed for thought in a lot more detail. So let's get with it. Let's talk about what's going on. Let's talk about the pandemic update. It's the fight between the virus and the vaccine. Who is winning? Well, one day it's the vaccine, but now it seems the virus, no, it's the vaccine again. And it seems like the vaccine is in the lead now, and we'll talk about that. U.S. markets, a little bit of nervousness here in the markets now. Interest rates are going up. I'll show you a 10-year chart. It's right at an inflection point. If it gets above that, it could mean some trouble for the markets. Are the markets ready for a interest rate tantrum? That's what it would be. Everybody's worried about, oh my God, the interest rates are going up. That means the economy is going to overheat. Well, first it's got to heat up before it overheats, but everybody is talking about that now. Even Goldman came up with an estimate of 6.1% GDP growth in 2021. I've talked about it for years. 4, 5, 6% GDP growth. That's roaring ahead. But we haven't seen that yet. As I always say, before you start shooting, you have to see the whites of their eyes. Don't start making assumptions that this could happen, that will happen, that would happen. It could have, would, and should does not work in these markets. You have to, all of us make assumptions. That is one of the biggest mistakes so many investors make. You have to go on facts. You have to look at cash flows. You have to do the analysis of the market. So many of you, 20 years ago, nobody used to look at charts. I used to talk about charts and people said, what are you talking about? We've come full circle now. Everybody's just saying, oh, look at this chart. It's got the parabolic, or it's got this and it's got that, and they forget about the fundamentals. Remember, this is a combination. You have to do your homework first. Make sure it's a viable company. It's a company that has got cash flow, that is going to survive the ups and downs of the economy. You've heard me say over 30 years on the radio, trees do not grow to the sky. Everything goes in cycles, and you have to have companies that can weather the storm. That's what you have to do, and the storms will come. Believe me, there will be bear markets, there will be more recessions, and so you have to be careful of that. But will the inflation come? I'll talk about that a little bit more. I'll talk about the charts and talk about collective investing. What is this whole collective investing about the GameStop and the Bitcoin and the cryptos? And oh my God, Bitcoin hit $1 trillion today as market valuation. So we'll talk about that. And I'm going to do an extended version of the charts today. My favorite topic, as you know, but we have to look at fundamentals before we look at the charts today. So let's start with the pandemic update. Good news here. Look at this. This is the number of infections, and boy, are they coming down. They're falling off a cliff. That is good news. And as I say, it's about 3 weeks later that we see the death rate also starting to decline. It is starting to come down. It has not fallen off the cliff like the infections, but it's going to follow. So that is all the good news that we have. But then we have B117 out there. What is B117? That's the UK variant, the mutant variant of the virus. It is out there, 50 to 70% more contagious. So what happens with that? Well, hopefully we can get enough people vaccinated where even if it does become the dominant variant out there, and dominant strain out there, I don't think it'll impact us as much because so many people will be vaccinated. And they found the Pfizer vaccine works against it. Probably Moderna works against it too. Now the other one is the South African variant, which is much more deadly. I believe, we don't have the data yet, but it is more, the efficacy rates of the vaccines are lower, still 50 to 60%. Believe me, the flu vaccine is only 50%. So, we had this home run with the 94, 95% efficacy where these vaccines work so well. Even with that, if we have enough people vaccinated, then we have enough herd immunity built in that we're not spreading the virus. That's really where we have to get to. So, it's just, and, they're saying even with one shot, you get 60 to 80% efficacy or more. Nobody knows that yet, but that's what they're saying. So let's get those shots, folks. Let's get out there. If you can, you qualify for it, go get it as soon as it's available, whichever one you can get it. I mean, Johnson & Johnson probably will be approved next week. And that will be, it's not as effective. It's very effective against the variant, the old variant and the British variant, but it's not as effective against the South African variant. So we will see, but any kind of vaccine you can get to protect yourself, do it. Hospitalizations, they're going straight down, and we're starting to see ICUs going down also. All of this is great news. So finally, we're getting the pandemic behind us. We're starting to look forward. How far do we go will depend. I think, as you've heard me say on the radio broadcast every day, I think the second half is going to be better than what most people think because there's so much pent-up demand. $2 trillion of forced savings that people are going to go out and make up for lost time. That is my feeling. So we could see that roaring economy. That's what everybody expects. And with that, we could see more inflation. As inflation goes up, ouch, that does hurt the stock market, because then the bonds start to compete with stocks and people say, well, if I can get 2, 3, 4, 5% somehow in the bond market, why should I risk my money in the stock market? So it becomes a competitive asset. It's not there yet, but it's getting there. Looking at look at, these are all the COVID deaths right here. And if you look at all the ages, all the deaths between 0 and 17 years or 18 minors basically, you can see that the death rate, that is for flu. You can see, these are flus. That's how many people die, kids die of flu. So thank God the kids are not being affected by COVID. That's all great news. And sooner or later, Pfizer is testing now on kids, and hopefully it will be available to the kids also so we can get everybody back out there. Schools are already opening, and I think that's good news out there. Lockdown or no lockdown, that's been the big topic that everybody's talked about. Here's California. It's in the last line. Here's Europe, which is the second red line. And this is the United States. And this is Florida. As you know, Florida did not lock down. Yeah, so more people died, I guess. It was a balancing act. How much you want to stay open, how many people die. You stay open, you get people can work, people can earn a living, and then older people die, unfortunately. So it was a balancing act. Those choices were made. Florida decided they wanted to stay open. California said, no, we're not going to stay open. We can see the results now in exact numbers. Is who did the right thing, wrong thing? That's something each one of us has to decide and look at. Schools, K through 12, attending schools, virtual schools has declined to 33.6. All schools that are open, currently open, 62% were closed over Labor Day, but now we're seeing 41% are fully open, in person every day. 25.6 are attending hybrid schools, part virtual, part every day, part going to school. So 60-some% of the kids are back in school, where they're spending some days in school, some hybrid, 41%. I think we need to get the kids back in school. They lost a year, but we need to get them back as soon as possible. And we are getting there, and I think we are going to get there. There's money being allocated to the schools, to $32 billion in 2022. 2023, 32 billion again, and this is for increasing the ventilation systems, increasing, again, I hope it does not go just to salaries. I hope it does do. We want to pay the teachers well, but at the same time, we want to make sure the kids have books, they have a great environment to go to, and we can improve the environment and improve the teacher quality there. That's where we need to invest in, not just on administration and all of the stuff, unfortunately, that a lot of this money goes to. Looking at the doses vaccinated, this is the great news out there. President Biden said that we are going to get 1 million people vaccinated a day. First 100 days, we're going to get 100 million people vaccinated. Well, when you look at the rates, we're about 1.5 million. That's what we're going on. Some days we got up to 2.5. It has slowed down a little bit over the last week or so, last few days, because of the bad weather in the Midwest. A lot of shipping did not go out. The planes could not take off, and all of that combined. So with that, I think we're going to pick back. But if we even stay at 1.5 million, 100 days means 150 million people vaccinated. If we can get to that number, I think we are going to be looking at the other side of this terrible, terrible situation that we went through over the last year. We can get back to some kind of post-COVID normal. And that's not going to be the old normal, the pre-COVID normal. That was a different normal. After post-COVID normal is going to be a different. We're all going to wear masks. We are going to social distance. But we are not going to be afraid of going out, going to restaurants, seeing our friends, hugging our relatives, and all of the good stuff that we do. We will be back out there. And with that, I look at the mobility numbers. Those are starting to move up. And as the mobility people start moving around, we will see the economy start percolating again. More people move around, more stuff, more people buy. And profits have been great. As a matter of fact, fourth quarter profits, earnings per share, were higher in the fourth quarter of 2020 than they were in the fourth quarter of 2019. So profitability is starting to go up, and that will bring the PE ratio down. Price, earnings, divided by earnings. If earnings number goes up, the PE ratio comes down. So the market anticipates that. I think it's pretty fully priced right here. We could see some pullbacks, but I still view those pullbacks as buying opportunities. That's the way I'm still looking at these markets. Looking at this new phenomena, so many of you have called me and asked me about Bitcoin and about GameStop and all of this stuff that's going on out there. Well, so many of you called me in 2000. Mo, I'm making more money day trading now than I'm making in my job. And you know what my answer was then? The same answer 20 years later. And people are saying, Mo, I'm thinking of quitting my job because I'm making more money trading. And I used to say, and I still just say, if you quit your day job, make sure you have a night job because you will need it when the bear market comes. Everybody's a genius in a bull market. We're seeing this phenomena where people are buying. They're looking at somebody, the roaring kitty, as he's called, Keith Gill. He said, buy, he's out there and he's saying, buy GameStop. And you heard me talk about GameStop at $40. It went to $400. And I said, watch out, folks. It's back to 40. A lot of people made money, hopefully some. It's not what you make, it's what you keep that counts. And as that market tumbled down, a lot of people lost a lot of money. Other people who got in first, got out somewhere at the top, those are the ones that made the money. Who were those? It's like the old pyramid scheme. The ones who got in first made a lot of money. People who got in last lost it all. So, I like to look at value. I like to look at cash flow. I like to look at how much money, what are the sales of a company. Yeah, you can bet on companies that could become the next Tesla or the Bitcoin or stuff like that, but you could also buy the next lottery ticket. I like to buy lots of tickets that have a very high probability, that have the cash flow, that are real companies, that can weather the storms when they do come. And it's not what you make, it's what you keep that counts. It's the slowly but surely is how you create wealth over a period of time. You've heard me say that for so long. You have to have a plan. You have to have the right asset allocation. And that's what we do for you every day. You can go to Compak.com right now, click on the button that says Get Started, and we'll do a free evaluation. We will show you a free roadmap to get you from where you are now to where you want to go. I know, it's very exciting to go out and say, okay, I'm going to buy this one stock and it's going to be the next Tesla, or I'm going to buy whatever it may be. But folks, it's slowly but surely. Yeah, you could buy those stocks and hit the home run. But when you try to swing that hard, you do strike out a lot. And you can't strike out with your entire financial future. Maybe take a little bit, as I call the Vegas money, have fun with it, but make sure you have the rest of the money in a good, planned, long-term investing. That's what you have to do. Technical analysis, let's take a look at the charts. Again, be sure if you like to see these charts on a weekly basis, as soon as I put them up, subscribe to the channel and make sure you click on that bell. So whenever I update, you will get a notice that there's a new update out there for you to look at. So that's what you have to do there. Let's start with something different today, the 10-year note. The 10-year note, the interest rate goes, as interest rates go up, bonds go down. That's what happens. And for 30 years, interest rates, 40 years, have been going down. I've told you the story so many times. In 1980, I went out and bought gold. I was young and I was a gold trader, and I said, oh my God, inflation, well, it's going to continue forever. Then the new chairman came out, big tall guy named Volcker, and he said, I'm going to kill interest rate. I'm going to kill inflation. I sort of laughed. I said, what does this guy know? How can he kill inflation? Well, he raised interest rates to 14%. Guess what? He did kill inflation. What did I learn 40 years ago? It was you don't fight the Fed. What is the Fed saying now? They're saying they want inflation, and they're going to tolerate higher rates of inflation. So I think we are going to get some kind of inflation. How much? How far? I don't know yet. So you have to prepare your portfolio to buy inflationary assets. That's not gold, but there are other assets that you can have to look at that do well in inflationary times. You have when it comes. Don't anticipate that it's going to come. I know so many of you called me in 2009 and said, Mo, we're printing money and it's going to cause inflation. Well, here we are 12 years later and we haven't seen that yet. It will happen sometime. Everything goes in cycles. But the interest rates going up are telling us that inflation could be coming. But if interest rates go up too fast, kills the economy, slows it down, inflation never comes. There was this gap right here between 140 and 143, 1.44 and 1.402 and 1.43. This is the gap right here. Do you see this? This is right here, and this was right as the market crashed. Rates came down, bonds went up. Now we've come right back up to that level. If we get above 1.3, then the next level is this 200-day moving average. That's about 2% for 10-year note. 2% 10-year note means about somewhere around 2.75 to 3% 30-year bond. I think the market is not ready for that. So we've got to watch this level that if we get above 1.43 or 1.44, interest rates could spike, and the spike in interest rates could definitely put the market on its back foot. I think the Fed will come out, make all kinds of statements, push the rates back down, but it could cause a temporary tantrum in the stock market because stock market has gotten used to free money or very low cost money. And if the price of money starts to go up, the economy slows down. People can't buy the houses because they don't care about what the house costs. They care about what their payment is. Interest rates go up, payments go up. They can't afford the house. They want to buy a car. They look at the payment. If the interest rates go up, the car payment goes up. They can't buy the car. If you can't buy stuff, guess what? The economy slows down. That's how the Fed used to use a brake to slow the economy down. But now the market is looking at this and saying, maybe we're going to see inflation. If inflation comes, the price of bonds, usually people say, look, you've got to give me more interest if I'm going to loan you money because my dollars that you get back, the inflated dollar is going to be worth less. The Fed, this way, the Fed can also get rid of debt. As you get more inflation, the value of debt goes down, and the debt that we've accumulated over the last 10, 15 years, we paid back in inflated dollars, and those are worth a lot less. So the Fed wants to get some inflation. I believe they're going to get some inflation. Will they be able to control it and just let it go up gradually and not go up too much? Will the bond market tolerate higher inflation rates? And will the market say, no, they won't be able to control inflation, the Fed, we are going to push interest rates up, slow the economy down, and that creates a problem for the stock market. Something to watch, something to think about in the short term. Here we are looking at this. We are looking at the levels. We are starting to pull back a little bit. Fourth down, this is a daily S&P chart. Support is right here at the 20-day moving average. Then we've got the 50-day moving average. If we break below the 50-day, that would not be good. Then we go down to the November low or the January low, which is around 3,700, I believe, and that would not be good. So I will watch this and see what happens. If we do get pullbacks, if we do get down to 3,700, it's about a 5, 6, 7% pullback in the market. I still think that's a good place to look at the market. Long term, also we're in the third wave. The extended third wave could take us to 4,000, but are we going to get the fourth wave pullback first? And the fourth wave pullback support numbers are right here. That's what I'm looking at right now. Same thing with the NASDAQ. We came and kissed the 20-day moving average and then pop right back up from there. That's what we saw. This is the daily chart of the NASDAQ. It's still long-term 15.2, then 15,800 are the numbers that I'm looking at, and that's long-term is what we're looking to do. Here's the weekly chart. If we get much below 13.2, that would not be good. I think that could put us in about 3 or 4 week decline in the market, and the parabolics get triggered. You can see where these parabolics get triggered. Once they get triggered to the upside, we usually get a weekly move to the upside for quite some time. They get triggered where we go down here for a number of weeks, 4 or 5 weeks usually. When they get triggered up, we can usually go up for months and months and months. So something to watch carefully, that if we get triggered on the parabolics on the downside, that would be, to me, a signal to watch the market. We could get a deeper correction. Gold, not good, folks. We broke the November low. Intraday today, we got to 1757. Managed to climb back up from that abyss. We break 1750, probably 1700 is the next support, which is right about here is the 1750. And if we break below that, then we are looking at about here. And that takes us down to what, about 1600 or so. So interest rates go up. People say, well, you know, that pushes the dollar higher. Should I buy gold or should I buy a bond for safety? Well, I can get some higher interest rate in bonds. So let me buy the bond, and that takes away some of the glitter out of the gold market. Something to think about, and I think that's what, but if we start to see a tantrum in the stock market, a little bit of a pullback, gold might start to glitter again. So something to watch if it happens. Long term, we did get a death cross where the 50-day moved below the 200-day moving average this week on Wednesday. I talked about it Monday and Tuesday that we could get that. We did, which is not a good indication, good long-term indication for the gold market. So that's why I've not been in gold. It's just, I think there's better opportunities out there. What are the better opportunities? Here it is, the emerging markets. I've talked about that for some time. I think the emerging markets are the place to be. Not all of your money, but definitely a portion of it should be there. If you're underweighted like I was for the last 4 or 5 years, and last quarter of last year we started to look at and add emerging markets to our portfolios, you can see they have gone, and once we broke above here, it looks pretty good. Obviously not every trade works as well, and these are my opinions. This is the way I'm interpreting these markets. Markets do whatever they want to, whenever they want to, but you have to look at the charts and go with the markets. Again, we're looking at the small cap Russell. That looks very good. We are getting a little bit of a pullback here. Came and tested the 20-day. If we break, then we've got the 50-day moving average as the next support. Don't forget, webinar. I'm going to go into a lot more detail, answer a lot more questions. That's Wednesday, 24th. Go and register right now. Just click on the link below and register. It is free, and I'll spend a couple of hours with you. That's my update for February 19th. I hope you have a wonderful weekend. Look forward to speaking to you next week in the seminar Wednesday night.
This presentation contains the current views and opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.